Hello, and welcome to this week's SFG Live Chat. My name is PJ Williams. Today, we are fortunate to be joined by Casey Frazier. Casey is the Chief Investment Officer and co-founder of Versus Capital. Versus Capital is based in Denver, Colorado, and manages close to $6 billion in assets across two closed-end interval funds focused on real assets. So Casey, thanks for joining us today.
PJ, thanks for having me.
And some of you may recall, Casey is a repeat guest to our live chats. We previously had him on back in May of 2020. At that time, we were a few months into the pandemic and still learning how to use Zoom. Now, 2 years later, COVID is still a discussion topic, but has been replaced at the top of the list of investors' concerns by persistent high inflation, a Federal Reserve that is tightening, increasing interest rates, and a war in Europe disrupting oil and grain markets. Before we get into our discussion with Casey today, I wanted to let everyone watching this chat know that SFG does have investments in both Versus funds. The discussion today with Casey will focus on the asset class of real assets and some of the sub-asset classes in which Versus is invested. No part of the discussion today should be viewed as a recommendation to buy or sell Versus funds or the various asset and sub-asset classes that will be discussed. And as always, if you have any questions during this chat, please submit them via the Q&A window. With that out of the way, let's jump in, Casey. So Casey, just to kind of set the stage for today, can you start off today with a refresher of what we mean when we say real assets?
Sure. Before we get started, I just want to thank you for the invite and allowing me to be on the podcast for a second time. I must have not screwed it up too much the last time to get another invite, so happy to be here. So when real assets can mean a lot of things to a lot of different people, but for Versus Capital, we view real assets as tangible assets, something that is physical or a hard asset, that's something that you could touch, and that those assets have contractual obligations tied to those assets. And so it's a really more refined definition. So we don't invest and think of real assets as precious metals or commodity futures, because those are financial contracts and not owning the physical assets. So for us, that subset of the universe that fits within our definition include things like real estate, infrastructure, farmland, and timberland.
And thanks. And I think, to start this off, I think we're first going to really focus on real estate. I know you're going to show here in a few slides some looking at broadly a kind of commingled portfolio of these different asset classes, how they have done. And then we're really going to focus on first real estate and then talk about both farmland and timberland to kind of close out today's session. But let's kick it off here on this slide by looking at how have these different asset classes done when the Fed's been raising rates, which again, that's a top of mind concern this year as they've been raising rather aggressively compared to what people have been used to during past hiking cycles.
Yeah, it's been an interesting hiking cycle for sure, and caught a lot of the market participants off guard as we were kind of hearing that inflation was transitory and that it was going to moderate as we moved here into 2022, and that hasn't been the case, obviously. And as the data has continued to come in, the Fed has been pretty aggressive in raising interest rates. But this isn't the first time that the Fed has been actively raising interest rates. So we went back and looked at over the last 30 years, what does it look like when the Fed has raised interest rates? And if you owned, those asset classes that we think are defined as real assets. So again, those four kind of food groups. And how have those assets performed in that type of environment? And how has a traditional portfolio that includes 60% US equities and 40% bonds, domestic bonds, performed during those time periods? So we said, all right, let's look at that historically. And you can look at these 4 periods here. And we could have added this new period, but we haven't gotten to an end of the Fed raising, but it would show a similar direction. In fact, significantly more dramatic year to date. But if you go back to the 94, 95 interest rate hikes by the Fed, private real assets portfolio, including those 4 subsectors, was up over the traditional 60-40. In the 99 to 2000 time period, also outperformed significantly during that 2004 to 2006 period. And then in 2015 through 2018, the most recent period before this one, also outperformance. If we look at the most current time period, this first half of 2022, or your 60-40 portfolio is down fairly significantly, depending on how you measure it, off, somewhere around 12 to 15%. These real asset portfolios are actually positive year to date, and would highlight that delta even further in this current environment.
Yeah, so you mentioned we're seeing a double-digit delta, depending on how you measure it this year, between these two. Anything you can point to in the 2004, 2006 range? Obviously, people are going to kind of gravitate towards a 25% outperformance over that type of time frame.
Yeah, all of those are interesting. It depends on the overall time period. That 2004 to 2006 time period was a really strong period for farmland, especially row crop farmland. So that was a big winner during that time period. Also, real estate performed really well in that environment. And so there were just, each of these subsectors performs differently in different environments. That happened to be a period where there was a lot of capital chasing both farmland and real estate assets. And so you had that kind of really significant outperformance.
And I do want to take a second here. We're going to talk about it later more in depth, but can you just quickly at a high level define a row crop compared to a kind of permanent crop?
Sure. Yeah. So when we think of row crops, it's actually the things you think of most when you think of farmland. Those are farms that can change in any given year what they're farming. So it's your traditional grains, wheat, corn, soybeans, and then also your vegetables. Anything that a farmer could say, hey, this year I'm going to grow potatoes, and I think next year it's going to be better to grow wheat. And so that's what a row crop is. A permanent crop is something that you don't get to change as often. They're typically grown on trees, so it would be things like grapes, olives, tree nuts. So any of your, pistachios, pecans, all of those grow on trees. And because of that, those trees take longer to be useful, but they also produce for long periods of time. And so you can't change. Once you've invested, you're going to be with that crop for more than 1 year, usually 10, 20, 30, sometimes 50 years until you take those trees out. So those are the differences between row and permanent crops.
Great, appreciate that. And again, we'll come back to a little bit more in-depth discussions on row crops later. We talked on this page on one investor concern is rising interest rates. I think the other main one, and probably the top of the list, is inflation. Whether you're going to the pump and you're paying $5+ a gallon for gas, whether it's in your weekly grocery bill, people are very concerned about this and what aggressive actions the Fed may need to take to get it under control. But if it continues to persist, obviously the word transitory the Fed used has turned out to not come to fruition. They may try to stretch their definition to be an 18-month window, but I think most people have given up on inflation being transitory, and now we're just looking for when do we see it kind of roll over and start cooling off, and can you really see that happen without the economy cooling off significantly at the same time, the Fed's idea of a soft landing. But with regards to specifically how these private real assets have performed during previous periods of both high and low inflation, do you want to speak to that on the slide?
Absolutely. Yeah, and obviously inflation has been a significant challenge, and PJ, you've highlighted it. It hurts every time you go to the gas pump. I did that yesterday, and you look up at the end and your gas pump clicks off and you have a little bit of sticker shock. But this isn't the first time that we've been through periods of above average inflation. Now, this has been some of the highest inflation we've seen in decades. But what has happened historically in these underlying private real assets segments of the market is they've performed well in periods of inflation. So this chart goes back again from whatever index that we're using for these private markets, however long we have that data. So in real estate, we have a long time. It goes all the way back to the late 70s, which obviously was a period of really high inflation and probably one of the most analogous periods to where we're sitting today. And it looks at how these underlying asset classes have performed when inflation has been above 2%, that Fed target that they're really trying to get back to is right at that 2%. So that's kind of the delineation. And when it's been below 2%, which has been, a lot of the last decade. But so when we look at these time periods in each of these segments, we can see that real estate has performed well historically. in times of above average inflation. Infrastructure, interestingly, performs well in periods of both above average and below average inflation. Farmland is very similar. It performs in line. Obviously, strong returns in both types of environments. And then private timberland has the largest delta, has historically performed well, much better in periods of inflationary pressures and than it has in low inflationary environments. And so all of these segments have held their own in periods of above average inflation when we look back historically.
And I think it's key just for everybody watching this to just look at, how far we are going back. It's not just the last 10 or 20 years, we're going back to the 70s on some of these, early 90s, obviously, on private infrastructure. So again, this has seen a number of different inflationary periods, maybe not to the extent that we're seeing right now. But again, even with private real estate, that did capture that late 70s, early 80s period of sharply higher inflation. Any other thoughts on how you expect, looking forward from here, assuming inflation does persist, but maybe the economy slows through at least the rest of this year and maybe into 2023? Any thoughts specifically on the outlook for any of these specific sub asset classes?
Sure. Yeah, we have a positive outlook on each of these sub asset classes in the current environment. So we could take those one by one, but let's just think about why these asset classes perform well in a period of inflation. So typically in each of these segments, the underlying cash flows generated by the contracts that are in place have a component of those that is either tied directly to inflation or that has the ability to move with what's going on in the market. And so that those, or some combination of the two. And so that ability for cash flows off of the assets to increase when there's inflationary pressures, or to be able to push down pricing challenges to that end consumer, gives these asset classes a leg up in inflationary periods, which is not the case for fixed income, for example, where you have a fixed coupon and it doesn't grow. So it has to reset, or you have to reprice in order to meet those. So that's one component of it, the ability to grow cash flows. The other component of it is these asset classes, when people start to get concerned about inflation, they start looking for tools in their toolkit to help protect their portfolios, much like a Stearns would, saying, hey, we're concerned about inflation. Let's think about what are the types of assets in the universe that have historically performed well in periods of inflation. So those are treasury inflation protected securities, those are commodities. Well, these real assets are given this track record that we're showing you, are one of those areas. And so as more investors start looking for inflationary protection or hedges, more capital comes into these sectors. And so that also creates an appreciation component that often happens in these types of environments. So with that backdrop, that gives you a good idea across each of these sectors why this might be a time period where our outlook is positive for each of the underlying sectors.
Yeah. Again, I think everybody understands these are long duration assets. Casey talked about the contracts, the inflation protection that some of them have with the increases already built in. So again, you can see that across these different areas. Well, I think this has been a good kind of broad overview we've been talking about. I think now let's jump into really focusing in on some different parts of the real asset class. So here, let's focus first on commercial real estate. Again, a number of our clients have investments in a variety of ways accessing commercial real estate, but do you want to talk about what we've seen on the volume side in terms of transactions for the last couple of years?
Yeah, it's almost like I knew what the next slide was going to be, as we talked about that last component, which was the demand for inflation protection type assets goes up in these environments. Well, certainly the data that we can show you on this chart, the transaction volume in US commercial real estate has been up, and it was up in 2021. It started off really well here in the first quarter of 2022 and into Q2. And so that transaction volume, the demand for owning these asset classes, it drives, because there's a finite amount of them, right? You can't, while you can issue more equity, you can't just create another apartment building in a dense urban environment. That takes a lot of time. There's a lot of cost to it. So when people are looking for those types of assets in these environments, you see transaction volumes go up. So that's kind of the first key. With strong transaction volume, that's strong pricing in the real estate market today.
Yeah. And I think, it's important to then look at what are we seeing within the different parts of commercial real estate. You have multi-sector, which again, think of as apartments. You have office building, which I definitely think we're going to talk on in a couple slides, because I think people still want to know more about where the future of office really is. You have retail, your average, storefront, grocery-led, grocery anchor tenant, kind of strip mall. So there's lots of different ways to invest in real estate. I know that y'all are focused probably mostly right now in the space of multi-sector family apartments and office, and maybe some industrial. But let's talk first about multi-sector or multifamily. Sorry, about multifamily, because I think when people are out there thinking about what's my future, you might be young, just coming out of college, a couple of years out of college, maybe starting a family, and you kind of been living in an apartment thinking, okay, I'm ready to kind of be, moving to that next part of my evolution, maybe in buying a single family home. Well, obviously we know mortgage rates have increased sharply, housing prices have increased sharply. Okay, now the outlook doesn't look so good in terms of making that move. So now I'm going to maybe stay longer in a multifamily apartment unit. What is that showing us in terms of when you look at vacancies? And then also what are we thinking about in terms of how much new supply is needed to kind of even everything out here?
Yeah, PJ, it's a great question. So this is kind of the perfect storm for the multifamily sector, right? When we think about coming out of the pandemic, you have a really strong job market. So people, said, hey, now I have this great job. I want to move out of my parents' basement. And so that's been a big driver. You also have a big demographic wave of the cohort that are typically renters coming into the market. So you have a nice large population that is going in. So you have a strong job market, a large household formation market, and the things that you just highlighted, affordability and the ability to buy single family housing is difficult. So there's three factors that are pushing people into the renting pool. And then kind of the fourth factor is we're in an environment where people are moving much more quickly and more often than they have historically. And so the flexibility that multifamily gives is also a benefit. So with all of these things, all of these tailwinds, we've seen multifamily vacancy rates, which are shown on this chart, have dropped significantly into their lowest levels that really we've ever seen in the market. And that's highlighted here. So across Class A, which are the newer buildings, the nicer and the best locations, down to Class B, which would be kind of garden style apartments, maybe not as new and maybe not as great locations, and then all the way down to the bottom, Class C apartments, which is really kind of affordable housing, work housing. All three sectors have just seen a significant drop in vacancy rates and are basically running at full occupancy. This gives a lot of power to the landlord because they have 10 people waiting for that unit to turn over. So they've been increasing rent. So we've been seeing rental increases at pretty significant levels. And given this backdrop, we would expect that to continue. And so this sector is poised to do very well in this current environment. And I think the other thing that we haven't talked about specifically with the multifamily sector and inflation, when you have supply and demand imbalance, or actually demand is significantly outpacing supply, and you have leases that roll every 12 months, this is a really good sector to be invested in an inflationary environment.
With the pricing power you're describing there, what if you're looking out the front windshield, what would be a concern for this space? What could come along and kind of reverse this, if that's possible, in terms of maybe having new rents in terms of the rate flatline or even potentially go down? I mean, besides obviously a severe recession like an 08-09 financial crisis where unemployment spikes, what potential headwinds do you see to this space?
Yeah, the biggest potential headwind is recession. You hit that nail on the head. The next is just affordability in a political environment that wants to cater to affordability. So rent controls or other things that kind of push that growth to a level that isn't sustainable, right? Or that isn't allowed. And so that would be kind of one of those idiosyncratic risks that you have to underwrite. Now, you can think about that in different parts of the country, right? There's a much higher risk of that in certain parts of California or all of California in New York than there is in the South, right? And so as our managers are buying properties, they're looking at those things to evaluate. So I think that's probably the one. Now, the other one is, again, it's about supply and demand. Real estate is a simple business. If we build too much new supply, that will put pressure, right? And if there's a building, apartment building next door that goes up and you get 150 new units, and that puts pressure on that building next door, right? Because they're going to try to attract the tenants who are 50 feet away. And so that's the other thing we would need to watch is how much new supply comes online.
So I think from the discussions, obviously, the net operating income of most of the multifamily space is doing very well and increasing. In terms of you as an investor, thinking about from an investment standpoint, the market value side, obviously we could talk about cap rates, but let's just stick to calling it a market value. Is it going up or down, just like a single family home? What are the thoughts in terms of how higher borrowing costs may affect the market values? Obviously, we've seen sharp increases in recent years. Do you think that side of it may be kind of flattening out?
Yeah, our house view is that that market value piece, driven by what someone is willing to pay, what income they're willing to trade off for, may change given the current borrowing environment. But that market value can still be going up because of the strong cash flow growth, or as PJ mentioned, what we call net operating income growth is very strong. And so even if you get that willingness, let's just say in today's environment, because I can get a treasury at a 3% cash on cash return, I would be willing to get a 4% return on multifamily. Well, if treasuries go to 4, maybe I'm going to need a 4.5 or a 5. And so that changes the value that you're willing to pay. But that amount will be dictated, right? If I'm going to get a 3.5% or a 3% on a treasury and a 4% on a multifamily asset, but that multifamily asset can grow that 4% income at a very strong rate, which is what the environment looks like today, given these vacancy profiles, I may be willing to even get closer. I may be willing to buy that at a 3.5% cash flow because my cash flow is growing so much. So there's a lot of levers that are getting pulled, but I think what you're ultimately getting to is, hey, as borrowing costs start to get higher than those cash yields, does that take some participants out of the market or making them wait? It will take some of the people out of the market who need to use financing in order to buy assets.
I guess the flip side of that is also higher borrowing costs may cause supply to not come online as fast because it costs more to build, and that route would obviously help people that are owners of multifamily.
Absolutely, and you already touched on this earlier, and higher borrowing costs are across the board, so that means less people can afford a house, so then it pushes more people in the renter pool, but it's kind of a circular argument there.
I think, the case for multifamily, I think the case, we're not going to touch on it much today. I know industrial, when you think of distribution centers, you think of data centers, I think people understand the case for that going forward and why there is one that has some tailwinds behind it. I think the one that people really struggle with is what we're looking at here. What is the future of office with, many employers allowing people to work remotely at least a couple of days a week? How do you see that going in terms of, we already have a ton of existing office space that probably a lot of it is vacant. We're still building new office, and obviously that's going to be the nicer, newer, have all the bells and whistles. And so obviously people are going to gravitate towards there and leave other older office buildings empty. What do you really see in terms of being an investor in the office space? And when you look at the outlook for this area?
Yeah, I mean, let me grab my crystal ball and I'll tell you exactly how office is going to be consumed in the future. Now, yeah, there's question there, right? People want to understand how the pandemic has changed the way we use office. And I think the good news is, right, as PJ mentioned, the first time we did this call 2 years ago, we were in the heart of the pandemic and our crystal balls were extremely fuzzy back then. But as we've gotten out a couple of years, we're starting to see what it is going to look like, most likely. And we're seeing a couple of things. I think you've hit the high point of our view is there's going to be a big bifurcation in the office market. And what I mean by that is office using employment growth is going to drive this economy for the foreseeable future. Now, there's all this talk about manufacturing coming back and these other things, but the way of the U.S. economy that it goes is going to be based on office employment growth. And so that's going to be the key driver. In an environment like we are in today, which is basically full employment, that means that you have to give your employees, they end up having some power. And what that power is today is flexible work environments. But when they are in their office, they need to have really nice options. You have to have high amenities. And so what this is pushing is it's going to push the office market to be focused in these markets that you could see here, where we're seeing significant office employment growth. So those are the markets that you're going to want to be in. And the types of assets you're going to want to be in are the new, well-located, highly amenitized assets. Those assets we think are going to continue to do very well in the future. But much like we've seen in retail over the last few years, the Class B mall, the Class B office in the middle of the suburbs that used to just house a bunch of people processing loans, those people don't need to be in an office. There's no collaboration. You can measure their output. You don't need to oversee it. Those jobs, those back office jobs that have typically been in Class C and Class B type office, and this is the same even in major metros like in New York, where you have really old buildings, that are very small and no amenities. We think there's going to be a lot of vacancy, and there's going to have to be a kind of a phoenix, right? You're going to have to redevelop those, much like we've seen a bunch of Class B malls and C malls get redeveloped into kind of this work, live, play environment with multifamily and retail and maybe a bit of new creative office. Those are going to be updated place. We don't think the office sector is dead by any means. We think that it actually is an attractive part of the market, but the delta between the best performing office assets and the worst performing is going to be significant.
No, appreciate that. And again, I think, like you said, a lot still TBD as we continue to work through what's hopefully nearing the end of the pandemic and moving back to what is life going to look like going forward. And like you said, there may be more flexibility, especially with unemployment being so low, just with what employees are able to demand from their employers. So we spent time here talking about what most people are familiar with, real estate. Let's focus again on the other three sub-asset classes that you discussed at the top of this that people may not be as familiar with. And so I think, again, on this page, we're going to talk about infrastructure. Here, you're going to obviously talk about specifically liquefied natural gas facilities and imports of that. We're going to talk about how the war is affecting this. But also, if you could just touch on what other examples are of infrastructure assets like toll roads or airports.
Yeah, but before we jump in and start throwing around acronyms like LNG, and let's just think about infrastructure. Infrastructure could be a lot of different things, but the key for it is just some characteristics that we use to define infrastructure. These assets are typically essential use in nature. These are critical assets to the functioning of daily society. And so they're critical things. And that is a big piece of it. Oftentimes they're monopolistic in that they're the only offering that does that. So, when you think about an office building, there could be a lot of office buildings, but if you think about infrastructure, there may be only one power plant in your area. There's not going to be 10 of them. And you as the consumer can say, hey, I really like energy XYZ, or no, I don't like it. It's like, hey, your utility provider is your utility provider. They own the market. So those are a couple of the characteristics. I mentioned this earlier, their cash flows, because these are very expensive assets to build, their cash flows are typically long dated contracts, and they oftentimes are directly tied to CPI, which makes them obviously attractive to inflation, or they're really long-term contracts that have some type of growth component, and then they have some type of GDP or market sensitivity. So in that instance, those would be like airports or toll roads. So when we think about the segments of infrastructure, we think about it a couple of different ways. So one, there's obviously the utility sector that would include all your electricity distribution, water distribution, all of those traditional goods and services that we all take for granted here in the US, frankly. Then there's also a growing and transitioning energy sector, right? And so the movement from traditional energy, so that would include traditional power generation to transmission or distribution of that power. That's energy movement of gas and natural gas and oil. And then there's this burgeoning sector of renewable energy and the transition of traditional fossil fuels to more environmentally friendly fuels. So that is its own sector. And then there's also some other new sectors, things like digital infrastructure. So we obviously, for the modern functioning of society, it's as important to have a good digital infrastructure as it is a traditional infrastructure like toll roads and those type of things. So airports and seaports. So there's a lot of different sectors within infrastructure. It's a vast market. It's based on, depending on how you think about it, it's a $50 trillion plus marketplace today. And there are very, very different assets and types of assets underneath.
Thank you for that overview. Again, I think people are learning more and more each time you come on about what all the intricacies about how many different layers and options there are for investing in the space and how nuanced some of it is. But focusing really on this slide, I think people are aware with the Russia war with Ukraine that Europe, especially Western Europe, does get a lot of their energy or gas needs from Russia. The pipeline was shut down a few weeks ago or earlier in the war. There's obviously continued discussions among EU members about how far to go with any blocking of Russian imports of oil or natural gas. But really on this slide, what are we looking at here?
Yeah, so this is just an interesting way to get. So liquefied natural gas is just a way to take gas created in one part, right? We obviously know that the energy markets, these fossil fuels are in different parts of the world, and the consumers of these fossil fuels are in parts of the world if they don't have those. So the nice thing about the United States is we have access to these resources. We don't have to import much. We're very actually, as we've grown in the energy market, have become fairly energy independent. But there are countries there are parts of Europe, there are parts, think about Japan, where all of their energy has to come from outside. And so liquefied natural gas is a way for someone outside of a market to pull natural gas out of the ground, put it into something that's smaller, easier to move, and then move it somewhere else. So in Europe, the growth of the amount of LNG that they've been importing has been steadily increasing and will continue to be impacted by the Russia-Ukraine conflict. Because as PJ mentioned, as you start cutting off those pipelines and other things that were piping in natural gas into Europe, then you have to get that natural gas in a different way. And so now you have to start putting it on boats there's a bunch of these facilities down in Texas, in Louisiana, where they pump natural gas out of the United States, put it on a boat and ship it across the world, to places like Australia, Japan, Europe. So that's what this chart shows. It's just an idea. We've all seen the pricing and really focus and gives, I think the biggest thing to focus on this is, as we think about this energy transition, we have to be realistic about the ability for us to move to more renewable sources. And we need to be thinking about how critical these access to these assets are. And when you own something that is a critical or essential use asset, We think that that really gives you a buffer from gyrations in the overall business cycle or the overall economic environment.
And I think you mentioned this. I mean, the size of these projects and the amount of money and the time it takes to build new facilities is longer than what is needed right now, especially depending on how far the EU goes with blocking imports from Russia. If we get to winter and we're still dealing with this again and energy needs rise, the U.S. and countries in the Middle East may or may not be able to kind of fill that gap that's been vacated by the blockading of Russia imports. And so again, what that means for the pricing in these spaces is that some of these commodities, natural gas or oil, could continue to face tailwinds that pushes the prices higher. And again, that would affect inflation, other things. So again, a lot going on here. But I think the key for this slide is that the energy transition is going to take a while. It's not a snap of the fingers. There's been missteps along the way in terms of maybe transitioning too early away from certain things like nuclear in parts of Europe. But again, that for the investing in the area, that there is some attractive opportunities in the infrastructure space, specifically when you're looking at right here, thinking about LNG export facilities on the Gulf Coast.
Yeah, fascinating time in the market. And I think this just does really highlight, and this theme will make its way into our discussion about farmland. You can't just turn on a switch, right? It's if you want to make 10,000 more iPads, you have to have built the infrastructure and the facilities and have the chip makers and all of the things in line. It's the same and actually exacerbated by 100 times, given the size of and the complexity to build facilities that can generate and create LNG exports. We have looked at a couple in the past. They're $20 billion assets that take 5, 7, 10 years to come online because that's very complicated. So to your point, you can't just snap your fingers and say, okay, we changed our mind. We really want to, build LNG facilities. You have to have been much more forward thinking. And I think one of the benefits of this current environment is a lot of the world is going to start thinking more forward, in our opinion, and you're going to see a significant amount of capital flowing into infrastructure in order to start putting in some of those redundancies that we clearly did not put in prior to this current environment.
Yep, definitely. We mentioned earlier that we could be coming back to row crops. So Casey, take us through this slide specifically. I mean, we're looking at exports to China, obviously growing in terms of the dollar amount. I think people's questions are going to be, is this somewhat a reflection of inflation, or is this we're actually exporting that much more in total in terms of mass of row crops? Anything you can discuss, obviously, on bulk total, consumer-oriented total, that may be confusing to some of our audience members.
Yeah, I don't think we'll get into the super down in the details, but let's just talk high level, right? So obviously coming into the pandemic, the Trump administration had China in their crosshairs and said, hey, we need to level the playing field. Well, China is one of those countries that imports a significant amount of goods, and specifically because of the size of their population, imports a significant amount of crops. And so when President Trump was looking for ways to hurt the Chinese, he focused on one of the biggest areas of export to them, which ends up being row crops, those grain commodities. And so that's why, as we were coming into this environment, our export numbers were significantly down. As we've changed administrations, and as the Chinese have been rebuilding their hog population, which had a pandemic of its own, where they went through something called swine flu and lost a big portion of their pork ability to generate pork. They've had to recreate that, and so they've needed to come back strong into the import market from the US from a row crop standpoint. So that's a big component of it. As we move into 2022 and think about these numbers, exports not just to China, but to everywhere, because of the conflict in Ukraine. The Ukraine and Russia are about 40% of the total grain basket of the world. And with the Black Sea shut down and the ability to move those goods, we have exacerbated a problem that we already had, and you're starting to see this making its way into the market. Concerns about food scarcity, obviously pricing is up significantly. So with the good yields in the market from an underlying crop growing standpoint in the United States, combined with significant demand increases, like highlighted here on this page from exports to China and the rest of the world, you're seeing high crop prices and which translates into more money into farmers' hands, which allows people who own farms to charge higher rent, which also allows people who are farmers to buy more land. And so it just becomes, again, one of those perpetuating cycles.
And I think obviously they're trying to take, I believe the Biden administration talked about taking some action to try to relieve some of that pressure from the grain that's kind of just stuck in silos by building some temporary silos on the border of Poland. Maybe they can use trains to export some, but again, that'll be a slow process. Again, the U.S., I think, when we talk about infrastructure, when we talk about farmland, I think you would agree that the U.S. continues to be in a very good spot relative to many of its both developed and emerging partners around the world. Just to be honest, we do have the Midwest, the fertile ground for growing row crops there. We do have the oil and the natural gas resources here in the U.S. So we are in a good spot. But when you think of maybe parts of Africa in terms of their ability to access food, if we're missing 40% of the grain supply, that's where that food scarcity you talked about really come into play here in the coming months or even years.
Yeah, absolutely. It's interesting. A large, certain parts of the world are rich in one of those areas and poor in another. The U.S. happens to be, very blessed, right? We have a very good energy ability to create energy and a very good ability to generate food, and so that does give us a bit of strength. We also have the technology and the capital backing, right? So we can be more efficient with the way we generate food, or we can be more efficient in the way we can capture fossil fuels, right? And or create some of the keys to that renewable piece. So we are in a very good place today from both of those standpoints.
Yep. Well, the last sub-asset class we're going to look at today is timberland. So why don't you walk us through the slide, what we're looking at here?
Yeah, so we talked a little bit about this in the multifamily discussion. We just have not built enough housing units. It's why single family pricing has gone so high. We all know that the amount of supply isn't meeting the amount of demand. We have this big household formation and demographic growth. But after the global financial crisis, so we overbuilt all through this time period, right? And then we hit the global financial crisis. And so we built up all of these homes, and then everybody stopped building. And they said, gosh, we have way too many homes, right? There was a bunch of stuff in foreclosure, and the pricing power went to the tenants in the multifamily sector. It went to lower prices in housing. And so that's an environment where people don't build. Interestingly, it took us a long time to get restarted. And then as the economy has come out of the global financial crisis, we just have underbuilt housing for a number of years. And part of that was just trying to figure out where the consumer was going to end up. We had a lot of people who were not going out into the single family market. And then as the economy had kind of went through the sea change during the pandemic, we saw a switch, and we saw people starting to build more and more homes. New housing starts in 2021 were at the highest level in over a decade. And so that has started to deplete some of that inventory. So when we think about timber, which is obviously a big component of the demand for timber, is housing or building construction. It's not just, it's multifamily, it's single family, as well as some other types of construction. We've been in an environment where the pricing in the timber and lumber markets has been low because there's been more excess supply and not enough demand. Well, that's got turned on its head during the pandemic. And then we saw obviously what happened with lumber, and timber prices have started to increase. And so we were able to, over the last couple of years, eat up some of that supply and move this back into more of an equilibrium. And in that more equilibrium, if we continue to try to meet the housing demand, we're about, as of today, somewhere around 4.5 to 6 million houses short. And we need to catch up over time, and that continues to compound and grow on itself. So if we, assuming we don't move into a severe recession, we think that there is a lot of tailwind for continued building of homes. Now, this is one of the areas that is the most cyclical or reflexive to what's happening in the business cycle. So when things are good, people build houses, right? And obviously we talked about mortgage rates have an impact here. And so this is one of those areas where you would see more reflexivity to the business cycle. But over the next decade, being undersupplied by 4.5 to 6 million and a growing cohort for new family starts or housing starts, we think that this is in a pretty interesting market now that we're back in kind of more of a supply-demand equilibrium.
Yeah. No, I appreciate that. Again, we've gone around kind of the world talking about 4 really different subclasses within real assets. Again, it's not exhaustive of the opportunities. Any closing thoughts you have as we walk through the disclaimers?
No, I guess, yeah, just in general, one, thank you for having us on the podcast today. We really appreciate Stearns and the partnership that we've created. I guess just high level, it goes back to how do we think about and where do we allocate capital in an environment that is very different? And that's what the thing that I love the most about being an investor, right? Every day we wake up, the environment has changed a little bit. And the nice thing about the sectors that we invest in, the sectors we talked about today, these tangible real assets, these are slower moving sectors that they have contractual cash flows, they have tangible assets. So even though we see the market race around and there's a lot of volatility in the markets, this is just a slower moving way to invest capital in areas that we think are set up to be more stable over time and generate returns and do well in inflationary environments. That's what they've done in the past, and that's our outlook going forward.
That sounds good, Casey. And again, we really appreciate you taking the time to hang out with us today and do this live chat. We will definitely invite you back again, hoping that there's less topics to talk about like pandemics and wars and high inflation. But again, I appreciate your time today, Casey.
Yeah, we appreciate it. There'll always be something to talk about. We just, we just have no idea what it will be, but we look forward to the next time we can be a part of this discussion.
Sounds good. Well, we thank everybody for joining us today, and we will look forward to having you on our next live chat in a couple of weeks.